Hi, I'm David Sanford, a different CPA, and today we're going to be diving into Section 179 of the IRS Code. I'll define Section 179 and we'll talk about 3 pitfalls, but we'll also explore some benefits. Let's talk about Section 179. The IRS allows businesses to deduct the full purchase price of qualifying equipment in the year it's purchased or financed, up to certain limits instead of depreciating over time. Depreciation is the accounting practice of allocating the cost of an asset over its useful life, reflecting its gradual decrease in value. Let's talk about the 3 pitfalls of Section 179. The first pitfall is it's not magic money. When you buy a piece of equipment, let's say it's a $10,000 piece of equipment, and you Section 179 it over the first year, that gives you a $10,000 deduction. If you're in the 40% tax bracket, it would save you $4,000 in taxes. Let's say you didn't do anything, and you didn't spend any money, and you just didn't buy a new piece of equipment because you didn't necessarily need it. That would save you nothing on taxes, but you would pay your $4,000 on that $10,000 piece of equipment you might not have needed. So now you end up with $6,000 in your bank account. That, in my mind, may be a better strategy if you don't need that piece of equipment in your business. The second pitfall, money now versus money later. The situation ends up being that if you buy a piece of equipment and you Section 179 it in the first year, but yet you're paying for that piece of equipment over a 5-year period, then you've got cash flow that's going out. So yes, you got a $100,000 piece of equipment, you save $40,000 in taxes, that sounds great, but now you're paying, let's say, $20,000 a year in payments for principal and interest over that next 5-year period. So now you've got $100,000 of cash flow that's going out without the tax savings. That's fine, but you can get yourself in such a leveraged position that it's difficult for the business to sustain growth and miss future opportunities. The third pitfall is, what if you don't keep it? If you don't keep that asset, let's say you buy an SUV, it's $80,000, you wrote the $80,000 SUV off the first year, and year 2 you say, you know what, I don't want this vehicle anymore, I'm gonna get something that's electric, I'm gonna save fuel now. Okay, great. You take that vehicle to the dealership and they're going to give you a trade-in value of $70,000 for that $80,000 truck you bought last year. Well, now you have $70,000 of immediately taxable income in the next year or the current year that we're in. So now you're going to pay tax on that $70,000, and maybe you only buy a $40,000 vehicle, and maybe it doesn't even qualify for Section 179. Then you can really amplify your tax situation in that year. So let's talk about some benefits of Section 179. The benefit of Section 179 is that if you've got a business and you've been pretty successful this year and you actually need a piece of equipment and you're buying it because it's going to improve the operations of your business, it's going to improve your daily workload, something along that line. Let's say it's a body shop, and that body shop is looking at buying a frame alignment machine, and their current frame alignment machine is 30 years old and it's slow and it takes 2 hours to set up. And the new one, it takes 30 minutes. Well, you're going to gain an hour and a half on every vehicle you straighten. So that's a wise use of money. Even if you had to finance that over a 5-year period, it's going to benefit the company every day that piece of equipment is put into operation. That's a huge benefit. And Section 179 is great. If you need the equipment, buy it. I struggle with businesses when they've been given advice that, oh, you don't ever want to pay tax. That's not true. Paying tax is a good thing. Paying tax is the right thing if you're being profitable in your business. And I'd rather hang on to 60% of my money and have it in the bank account and pay 40% in tax than getting off into, I'm going to buy equipment I don't need just so I don't have to pay income tax.
These pitfalls kind of point out short-term thinking and short-term planning strategies rather than a long-term approach. We take a birth-to-death approach on our businesses. We don't just plan for a quick fix. We don't plan for a short-term strategy. We're planning for legacies of our businesses. We're planning for that business's next generation potentially, and how we transition, whether we're selling that business to someone else or whether we're moving into a new phase of the business and growth into different streams of income or cash flow. Again, it's a long-term planning strategy.